Of what we heard so far, how effective has it been?
Yeah, so far I think investors really welcome this capital market reform. Since March, we've seen CSRC announcing a list of measures that's targeting at improving the quality of listed companies, as well as strengthening scrutiny of new listings. And those efforts really culminated in March. We had this once-a-decade capital market reform plan coming out from the state cabinet, which is a higher level authority that indicates coordinations along different parts of the government. But more importantly, since then, we've seen daily actions from news headlines talking about how, CSRC, we're sending probes into securities firm. We're also having, targeting individuals who are suspected of insider trading. So I think so far what investors see is there's not only determination, but also real actions in terms of enforcement of these plans to make China's capital market more competitive.
Jason, you've done some work on this, you and your team. Is this a big deal?
Sure. I think to Charlotte's point, there are actually some real action that is happening, which should provide a little bit more confidence about their commitment to this. I'll also divide the reform into two parts. There's a part that's on the operational side, like, for example, insider trading, restriction on some of the high-frequency trading. But there's also the other part about the quality of the market as well, which is what we think the corporate governance reform in China is actually quietly taking shape that maybe some of the investors are not as well aware.
And what are people missing in that part, the corporate governance side of things? I mean, how substantial is it compared to other markets that we see in Japan and Korea, for example?
Sure. I think corporate governance in China historically is quite a challenged term because I think there is a natural skepticism about the governance themselves. But what is interesting is that after what we've seen happening to Japan over the past 8 to 10 years, that the policymaker really successfully engineered a positive feedback loop between the companies and the investors. And now I think trying to look at what happened to Japan, and they're trying to see what elements can they take from that. And I think the biggest part of that is actually dividend reform, which we're happy to talk a little bit more. But that is something that is quite unusual in terms of having policymaker mandate a company to pay a certain threshold of dividend.
Why not? Okay, so is that the lowest hanging fruit here? Is that the initial win, the early wins, more dividends and bigger payouts?
Sure. I think that is based on the current set of policy. Yeah. That seems to be the one that they are most focused on with actually a quantitative threshold. That is actually one of the bigger difference between what China is trying to do on corporate governance versus perhaps Japan and Korea. And so if you look at some of the big companies, their payout ratio is still actually quite low. So we have profitable companies in China across the state-owned enterprise as well as private enterprise. But very often, the smaller companies, they don't tend to pay dividend, despite the fact that they're making good profit. And so the more immediate action plan seems to be linking the ability for the company to finance versus their commitment to pay dividend. And that is trying to align the priorities of the companies and the shareholder, which is something quite unusual based on the previous reform attempts.
And there's another thing that really attracts attention is about revamping the listing standards, which earlier some investors worried about whether this plan is targeting small caps. I wonder if you see that.
Sure. I would say that there's certainly some confusion or fear in the market earlier last week when some of the announcements mentioned that, the small mid-cap company may be categorized under the so-called ST tag. And then the CRC come out and say, that's not exactly the same way. I would say, going back to my earlier comment, if you look at the starting point, it is true that the small mid-cap companies are a little bit behind in terms of their dividend payment policy. And so perhaps there's more room for them to catch up. And in the meantime, the government is also putting pressure on it. So there's a little bit of that push and pull factor. In the near term, perhaps those small mid-cap companies will feel a little bit more heat. I do agree with Charlotte on that. But I don't think that is the original intent to delist all these companies. It's just that to give them more incentive to kind of be in line with the broader market when it comes to dividend policy.
And you're looking at the more upstream, midstream sort of basket. I mean, what is in that basket now that could be benefiting from these measures?
Sure. So I think this is a basket that we previously mentioned about. We have these subset of companies that are in energy, material, and industrials, which has done surprisingly well this year, partly due to domestic factor because of this kind of dividend payment reform, as well as the international factor, that the fact that China is exporting quite a lot of the capital goods externally. So the way we think about this is that this is a high-quality basket where some of the domestic asset allocation may come in because of the high dividend yield and this kind of steady profit growth. And then on the other side, the valuation itself is also quite defensive. It's trading in line with the broader market, which we think is a nice combination of benefiting from the current macro scenario as well as the micro scenario of corporate governance.
Right. And this is also, I mean, not a lot of people realize how hard it is to be able to list your stock in Shanghai, right? That, the profitability requirements to get there. But I'm surprised right now that not a lot of people know about the, being able to share those profits to your shareholders. And I'm wondering, when do you think we enter the phase of, is shaming a good way to describe it? Conscience, for example? Do we need to they need to regulate people to start giving out specific payouts?
I think that's a great question. So I'll probably compare the corporate governance reform attempt we've seen in Japan, Korea, and now in China, because they actually share different elements of that. As with many policy, we need a push factor and a pull factor. And if you look at Japan, they seem to create this rather nice equilibrium of push versus pull. For example, you have the stock exchange telling company they have to go above 1x price to book. And on the other side, you have companies actually following through and really pay out dividends and buyback, and their shares get rewarded by shareholders. So I think that's probably the more ideal scenario. But it took Japan 8 to 10 years to get to that point. And if we look at Korea, they seem to be focused more on the incentive at the moment. There are probably a few more follow-through coming through. But in the case of China, they seem to focus more on the regulatory side first, and then perhaps with a few good examples, then the investor will start rewarding companies by following these changes. And then we get to a more nicer equilibrium.
How do you think the market is going to react to these sort of measures? I mean, we bring up a chart that kind of shows how the market's fair when 2004 we heard the first round, then 2014, which eventually did lead to the stock connect and all that. And you see a substantial kind of bump up in stock price and really just momentum. Are we likely to see the same this time around?
I would say that this time around the setup is slightly different, because if you look back at the previous two episodes, it's not just the stock market. They also have a combined policy from fiscal and from monetary, and also the external environment also quite different as well. So I would say that based on this particular article alone, it's probably not enough to repeat those kind of very surprising return. We'll probably need to see more coordination across different ministry, and you probably need to see more active support from both fiscal and monetary side in order to create this kind of combination for the equity market.
Right. That chart is quite astounding, isn't it? Can we get that up again? I have another question on that. I mean, you look at the Shanghai Composite going back to 2003, Jason, and this looks like a frontier market index in some cases, right? So I guess the other question is, 2006 to 2008, 2015 to 2016, what do regulators need to do to prevent booms and busts of this sort if they want to create a more value-centric market and push away the frenzy?
No problem. I think that's an excellent question, even including the choice of using the Shanghai Com Index, because the reason is because Shanghai is only half or one-third, depends on how you measure it, of the overall China market. So part of that battle is that we need to find a good benchmark that actually represents the overall China market. So what you tend to see is that we may be looking at one or two indices that may not give us the whole picture. Right. And that is why part of the capital market reform is to ultimately identify the S&P 500 equivalent for China, where both institutional investors and retail investors can be aware of where they can find these high-quality companies, which will provide a little bit more sustainability when it comes to that investment process.
What's the closest benchmark right now to an S&P 500-esque?
I would say that based on market cap selection, you do have the CSI 300 because they have the similar market cap selection. But we also see new indices that are popping up with a little bit more sector selection as well. So I think we're still in that process of going through various formats of index construction that can eventually arrive us at a better index for long-term investment proxies.
Interesting.
Another plot from this document is to attract more long-term funds into the market. And this isn't new. We've hearing authorities talking about this, since last year. So how do you think authorities can make this happen, especially at this point, which we really need for long-term funds to come into the market?
Sure. That's a great question. I think the CSRC chairman, Wu Qing, also acknowledged that in many of his interviews, talking about we need both short-term and long-term, but the long-term capital is harder. The way we think about it is that this dividend reform is key, because when we think about long-term investors, they typically look for two things: capital appreciation and cash flow generation. And so by having a more stable dividend, you may be able to attract funds like pension and insurance, because right now the Chinese government bond yield is very, very low by historical standard. And yet if you can identify companies that are paying you 4 to 5 stable dividends, that is actually a very attractive value proposition for these long-term capital.
So if we're picking stocks, and I think you mentioned the BNP midstream, upstream benchmark, what is the most relevant valuation metric to look at right now to be able to decipher and filter out
the winners and losers?
Yeah, like undervalued stocks or stocks that might be might benefit from this.
Sure. I think there are two approaches here. The basket that we just discussed is the one that are existingly they're doing well, that the long-term capital may want to kind of gravitate towards because they don't necessarily have the conviction to look at new things. So that's the first part. The second part is something more akin to what Japan has gone through, where company with low valuation or high profitability but low payout ratio that are being under pressure to pay dividends. So, for example, we've also identified a subset of a company that fits into that role. And the good news is that these companies are reporting in the next few weeks. So I think one of the measurements is to see that these companies with reasonable profitability, are they now willing to increase their payout policies so that can generate more investor attention?